A good starting point with your technical analysis can be to look at the price structure. Regardless of what method you're using for analysing the markets, the price structure is useful because this provides us with important information at a glance that can help us to understand what's been happening in the market and how this may impact what happens next. So what is price structure? So take a look at this chart. You'll notice that the price tends to fluctuate up and down. So these are oscillations in the price movements, which we commonly refer to as the waves in the market. Each wave is made up of two legs. You have a bullish leg, which is the price move from the low to the high, and the bearish leg, which is the move from the high to the low. Now, the combination of these, either a bullish leg followed by a bearish leg or a bearish leg followed by a bullish leg, creates one wave in the market. And when we have several waves, or price oscillations if you prefer to use that term, we now have price structure. And we can take some insights from this. So let's start with some of the basics that most traders know. If we have several waves with higher highs and higher lows, the market is in an uptrend, also known as a bullish trend. And if we have the opposite and we have several waves with lower highs and lower lows, the market is in a downtrend, which is also known as a bearish trend. So those are price structures with a clear directional bias. The market is generally moving in one direction or the other. But there are also times when the price doesn't seem to be moving mainly in one direction. And we can see this in the price structure when the highs and lows are mixed and the price is generally staying within a certain price area. So we would call this a sideways market because, surprise, surprise, rather than it trending, it's moving more or less sideways. Now, sometimes you'll notice with a sideways market that the main highs and lows are almost exactly in line with each other, as if there's something at those points in the market that's causing the market to stay within these strict boundaries. Now, at Duomo, we specifically refer to that type of sideways market as a range. Now, other traders use the term range just to describe sideways markets in general or in other contexts, but that's how we define it at Duomo. Now, with these types of movements, the sideways markets, you'll also sometimes hear traders use other terms to describe it, like consolidation, accumulation, value areas, and a whole range of different names, depending on what method of trading they're using. Now, there are some nuances for each of these terms, and they do describe specific situations sometimes, but you don't need to know about that just yet. But just be aware, if you're looking at a sideways market and someone's calling it something else, and you're like, hold on, I thought that was sideways, it may very well be a sideways market, but they're just picking up on something else there, or they're just naming it differently. Now, typically in normal market conditions, even a strong trend will have pullbacks where it moves in the opposite direction. It's not that common that a trend will just be continuous candles all in one direction, although it can happen particularly after a data release or something else that's completely changing the value of an asset. Now, the reason price structure exists is related to how prices move in the markets. That's what's causing these pullbacks. Price moves based on imbalances between volume and liquidity. So if it moves up, there's an imbalance that favors that direction, but then it reaches a point where there's no longer an imbalance, and then perhaps there's an imbalance in the other direction and it reverses. And we'll discuss this in more detail in a separate video. You know, there's a really simple way to think about these price movements. I think it's a good way to think about it when you're first getting started. It's what I always encourage people to do. And that's to imagine a shop. Okay, now this isn't a perfect analogy. This isn't exactly what's happening in the market, but it helps you get the right sort of perspective when you're first getting started in the markets to understand why the structure matters and how different structures can be interpreted differently. So imagine I'm selling a product. I've got one product and I'm selling that in my shop. And as I increase the price, people are still buying more and more. So I continue to increase my price further because I've got limited supply or whatever it is. I know I can get away with it, price gouging. I'm going to increase my price and people still keep buying. But then I reach a certain price point where it's high enough that no one is buying anymore. So at that point I decide, okay, I'm going to start dropping my price by giving a discount. And this is where things relate to the price structure. So let's say I drop the price by 1%, I give a 1% discount, and people are straight into the door and buying back again. They're really interested in my product, even just with a 1% discount, they see that as a bargain. Well, that's a positive sign that I'll probably be able to increase my price further because there's a lot of demand for it. It's not taking much of a discount to get people interested again. So perhaps we can think of that like structure like this, where the price is direct, we get a small pullback and it continues. Small discount led to demand coming back in. Whereas if I'm going through a 2%, 5%, 8% discount and no one's buying, and it's not until I drop it by 10% that people come back into my shop and start buying again, well, that's changing the way that I perceive the demand in the market. So if I compare those two situations, it gives me the context I need to understand the current situation. Now, again, this isn't a perfect analogy because it's not literally what's happening in the market. We can discuss the supply and demand relationship and volume and liquidity in a separate video, but I think it's just a good mental model to use to be able to compare different price structures and interpret the differences in the context to understand what's going on differently here. It makes things much easier to think about it in terms of a shop that's giving a discount on prices. But if you want to learn more in depth about trading and start getting into the slightly more complex and much more useful aspects, check out the links below for some free resources. Thanks for watching.